We've all been there to some extent during a tough trading session as a day trader, where our losing trades has really caused us some grief. Maybe we skipped our prep for the day, or perhaps we were just distracted while we're day trading, or maybe the market just flipped and it handed out losing trades on a regular basis on what's normally a great play. Well, it's not too difficult to see that when we feel cheated or frustrated, there's a danger of slipping into the whiner and the sore loser mentality. The way I see it, trading acts like drawing venom out of a bite. It brings out ugly emotions that we really need to learn to control and naturally avoid if we're going to prosper in the long run. And a part to sore losing in trading is loss aversion. This is part of human nature, and trading really brings it out in all its glory. When we have a good trading strategy and it takes a series of losing trades, it's really easy for this to come out. Not only does loss aversion tend to make us not want to lose what we have, it also makes us not want to accept the losses that we've already taken. And this is particularly becomes worse if we don't understand the concept of trading probability, that our trading strategy is going to lose, and start to believe that the market must just be wrong. Trading isn't always about doing X and getting the result Y. Of course, the next stage is abandoning the trading plan as clearly it's useless. It absolutely must be understood that even when you execute a good trading plan, there are going to be times when you must take a losing trade. Now, I want to point out that being a sore loser and hating losing, not really the same thing. Sore losers usually hate losing as well. But hating losing is something to cultivate if you want to become a good loser. And I hear all the time that people say, learn to love small losses. Well, frankly, I hate all losing trades, period. I prefer to take small losses over big losing trades, but I certainly am never going to like, let alone love a loss, whether it's small or large. There's a good amount of things in trading which can seem counterintuitive, but this one, I think it's pretty wrong. And the reason I say it is because it goes against our nature and what we're trying to achieve. It's better to hate big losses and therefore take small ones instead. Just don't love small losses. And it's important to define small, as it leads the mind to thinking taking losses of only a few ticks is going to help you be successful. And this can be the complete reversal of reality. Small really means getting out of a bad trade as soon as you can. That means you might have a set of criteria or seeing some type of price action which will get you out of the trade before it hits your stop loss. It also means not mindlessly just clinging onto a trade in the red when it's well beyond your stop in the hopes that it's going to come back. Letting a trade run past your stop loss is horrendous money management, and it's going to cause you to take a loss that's much larger than you ever planned for. Now, hating losing can also be a big motivator as well, and a great deal has been said about leveraging our natural emotions to achieve desired responses. If you can use it to motivate you to prepare properly, to make sure you're mentally ready to trade, focused, and free from distraction, then that is a positive response to the strong emotion. It's the will to win, not the refusal to accept losing. The effects of sore losing are really quite negative, but perhaps they're more wide-ranging than many would believe. And they could be demotivating and demoralizing as a trader. If a good trading plan fails and you start to believe there's something wrong with it, you're far less likely to stick to it. But also taking into account all the effort that you put into creating and backtesting and preparing your trading, it can act to make you feel incapable and less willing to put the same effort in again. Antagonizing. And this can be pretty destructive and push you into taking rash, revenge type trades and a position size that you would not normally do. Believing at the time that the market must be wrong and being annoyed that this has the audacity to take money off of you, you go on a personal crusade to take it down. The market doesn't really care. Deceiving. With your head spinning with the emotions of anger, disappointment, inadequacy, and whatever else, the true form of the market is likely to become pretty blurred. You might think at the time it's crystal clear, but that's probably not the case. Emotionally destabilizing. Because of all the emotions which you feel, the ups and the downs of each and every trade can start to be felt 100-fold. Each tick against you is like a statement of how terrible you are at trading or how stupid the market must be, and ultimately drive you towards losing control and discipline, preventing acceptance of losses. If you place too much importance on any one trade, you could find yourself in a position where you've been well on side and you end up losing because you wanted more on the trade, or a refusal to let go when a trade goes wrong results in being forced into taking a big loss. And this happens usually right around the time before the market just reverses on you. Following on from this is by not accepting cumulative intraday losses within your daily stop limit and fighting to get back to even. The temptation is to try to make back the entire amount in one big trade, which is not planned for, and it's pretty unrealistic. Decent trades can turn into bad ones, and it can compound the losses for the day and really cause further psychological issues. The first step to rectifying this problem is recognizing it. And this is why people are always bang on about keeping a journal. If you think that you know you have certain issues and what they are, journal for a sustained period of time can be an eye-opener as to why they occur and to what extent. Next, you must start out the day by accepting that you don't know whether that next trade you're going to take is a winner or a loser. And this is whether or not you've done a bunch of strategy testing and your results say that historically and in your demo account, the system you're using has a 99% win rate. Number one, all of the 1% which are losing trades could come in a cluster. And number two, the market could just change and the strategy just loses it being effective. Trading strategies tend to have periods of working really, really well, and then less well. Then you must see when you take a loss, the annoyance generated by it should elicit a planned response rather than an uncontrolled one. When you feel that wrenching in your gut because you've just taken a hit on a trade, you must train yourself to wait, reassess the situation to see if you really think the market is telling you what you had originally thought. Just don't immediately jump back into the market. Perhaps that 3-strike rule is one which you may benefit from. This is if you take 3 losers in a row, you stop trading, you step back, you reassess. Possibly go for a walk, go to the gym, just get your mind off of trading. Then reappraise the market and recenter, refocus yourself before getting involved again if, of course, you're still within your daily loss limit. Now, feeling bad about losing trades doesn't mean you have to be controlled by untrained responses to the emotion. Instead, if you can use this to drive you to prepare well, to be ready to trade each day, and make sure you're focused and free from distraction, you'll be harnessing the power of emotion rather than being a sore loser every time you take a losing trade. Thank you for watching this video, and it'd be great if you could hit the like button below and take a moment to subscribe here to the right. You can also enjoy this other video that we've chosen especially for you.